Welcome, everybody. It's hard to believe it's July, and we're here to discuss the Main Street Lending Program, which has been officially open now for 2 weeks. Please post your questions in the Q&A app only. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com, and later in the day, we will also email a copy to participants. Briefly about myself, I am the founder and CEO of MultiFunding. I write regularly on Inc. on business lending issues. I've advised prior administrations, as well as the Federal Reserve, on business credit markets. I have a book out called The Growth Dilemma that you can find on Amazon. My lawyers asked me to share a few disclaimers. We are in unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this Main Street Lending Program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. COVID-19 has changed the world, and as business owners and entrepreneurs, this is the time to be reimagining and thinking about our businesses and what is next. In many ways, we are preparing and getting ready for a battle. And in a battle, you need to worry about a couple things. What is your strategy? Are you going to pivot your business 5%, 50%, or 90%? What will your team look like going forward? And how much ammunition are you going into the battle with? And in this context, ammunition is cash. And you want it for both offensive and defensive reasons. How much cash will be required to get your business back on a stable footing? What is the best case, worst case scenario? And where will the cash come from, and how much are you willing to personally risk? And what does your future look like, and what opportunities will you be considering going forward? These are the framework I'd like you to think about the Main Street Lending Program. The program has $600 billion allocated for it. It is in effect as of right now until September 30th, 2020, and it is comprised of 3 facilities: the new, the priority, and the expanded. Let's dig in and learn all about it. I want to just set some context. We all are living in the halo and still surrounding the world of PPP. Main Street lending is nothing like PPP. It's not an entitlement program, and nothing will be forgiven. Banks are going to take you through traditional underwriting, and you're responsible for paying these loans back. And you have to put this into context. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be to go through your existing bank, and I hope they will be participating. If you plan to use a Main Street loan to expand and grow, more banks will be open to you. However, in 99% of the cases, the banks that will be doing these will be your local banks, and they will require your deposit relationships. You're going to get these at a bank. And as of now, there are about 300 banks who have signed up or in the process of signing up for the program. And we don't expect a whole lot more than that to sign up. This will not be available at every street corner across America. To be eligible, you need to be established prior to March 13th, 2020. And you have to meet at least one of the following 2 conditions. If you have more than 15,000 employees or annual revenue of more than $5 billion, you're too big. You also have to be created or organized in the United States with significant operations in the United States. What is the U.S. eligibility test? An eligible borrower, that means at least 50% of your assets are in the United States. Your annual net income is generated in the United States. Your annual net operating revenues are generated in the United States. And your annual consolidated operating expenses are generated in the United States. Subsidiaries of foreign companies can apply, but you have to commit that you will not send the money out of the country to your parent abroad. Eligible entities are partnerships, LLCs, corporations, associations, trusts, cooperatives, a joint venture with no more than 49% participation by foreign business entities or tribal business concerns. The Federal Reserve is working on a program for nonprofits, but that is not open right now. Ineligible borrowers are developers and landlords. So if that's your primary business, you're not eligible. And there are certain other industries, such as private equity companies cannot apply, sex companies cannot apply, and other lists of random companies that cannot apply. How do the affiliation rules work with these programs? If you are part of several companies, an affiliated group of companies can participate in only one Main Street facility, so the new, the priority, or the expanded. And the affiliated group's loan cannot exceed the maximum loan amount for that facility. So say you pick the priority where the maximum is 50, one affiliate can get 25 and the other affiliate can get 25, but that's it. And an eligible borrower's maximum loan size would be limited by its own leverage level. Now something has changed a bit. A few weeks ago, the rules were that if you held your real estate in one company and your operating company in another company, the debt of the real estate would count, and that would often mess up people's availability for the program. That has now changed. So if you own your buildings in one company and the operating company in another company, you can operate. You can borrow just through the operating company. Let's dig into the facilities, the new, the priority, and the expanded, and let's start with the new and the priority. They share some attributes. They are secured or unsecured. They have a 5-year maturity. Principal payments are deferred for 2 years and interest payments are deferred for 1 year. Principal payments, what you're going to essentially pay is you're going to pay no interest in year 1. Then in month 13th, you'll start paying interest payments, so the interest does accrue in year 1. At the end of year 3, you own 15%. At the end of year 4, you own 15%. And at the end of year 5, there's a balloon payment of 70%. These are priced at an adjustable rate of LIBOR plus 3%. And you can count on paying approximately 3.25% right now for these loans. Prepayment is permitted without penalty, and the fees will be 2% to get in. The banks have the discretion to charge you 1 or 2%, but the banks are making a little money on these loans and will be charging the 2%. They have to send 1% to the Federal Reserve. The new facilities are between $250,000 and $35 million. How do you calculate how much you're eligible for? Well, what you do is you take 4 times your 2019 EBITDA. So let's take as an example, row number 3, company with $500,000 of EBITDA, the maximum new loan facility they could get would be $2 million. If that company has existing debt of $1.5 million, their potential new money loan would be $500,000. If that's the very same company in row 1 only had $500,000 worth of existing debt, they could get a potential new money loan of $1.5 million. What matters here in the new is that if you have existing lenders and you're getting a new, you have to negotiate with your existing lenders that in case of bankruptcy, they will share rights with the Main Street lender. But in the normal course of bankruptcy, their rights can be in the normal course of business, their rights can be subordinate. These loans can be secured or unsecured depending on what other debt you have and what you'll be able to negotiate with your lender. And you are able to take additional debt after you receive the loan, as long as you do not, that debt does not have higher contractual priority in bankruptcy than the Main Street New Loan Facility loan. Now let's talk about the priority facilities. These go bigger. They go from $250,000 to $50 million. Let's take that same company, because on these loans, you can get up to 6 times your 2019 EBITDA. So let's take row number 3, that same company with $500,000 worth of EBITDA. In this program, they could get $3 million. But if they had $1.5 million worth of existing debt, their potential new money loan would be $1.5 million. That same company in row number 1 with $500,000 worth of existing debt could get a potential priority loan facility of $2.5 million. What's unique about this program is that you can refinance debt with other lenders into it. And sometimes this makes sense, especially if you have debt on less favorable terms and higher rates. But in the priority loan facility, the lender's rights have to be senior or on par with all other lenders except for your mortgage or, in some cases, equipment lenders. These loans can be secured or unsecured, depending on what other debt exists and what you negotiate with your lender. And as a very baseline scenario, a company with $41.66 thousand of 2019 EBITDA and zero debt could borrow $250,000 with this program. But I want to be clear that we believe it will be highly unlikely that any of these loans will be issued for under $1 million. Just the paperwork, the legal costs, and the intricacies of them make it highly probably not worth it to get anything less than $1 million. The expanded facilities are bigger. They start at $10 million and they go as high as $300 million. So as an example, and these all work in tandem with your existing lender. So if you had a company in row one of $10 million of 2019 EBITDA, their not to exceed would be $60 million. That company had $25 million worth of existing debt, they could get a potential expanded facility of $35 million. These work in many similar ways with two differences. The rights tag along with the rights of your existing lender, and the fees to get in are 70.75% to 1.5%. In all these loans, you commit to refrain from repaying principal balance of other loans that you already have, or shutting down your current lines of credit while you have the loans. And in addition, you agree that you signed a covenant, you signed a certification that you're full reason not to believe that your business will go bankrupt in the next 90 days. While you have the loan, you can repay a line of credit, including a credit card, in accordance with your normal use of business. You can take on additional debt as long as it does not conflict with the rights of the lenders, and you can refinance maturing debt. There are certain, and this is important, compensation requirements and restrictions. You have to commit to follow them. There are some exemptions for tax pass-through entities that you can get allowances to pay your taxes. You agree while you have the loan and for up to 12 months after you have paid the loan in full, not to make dividends or make other capital distributions with respect to the common stock of your business. Those who earn between $425,000 and $3 million in 2019, you agree while you have the loan and for 1 year after to cap your salary or your compensation at that amount. For those who earned in excess of $3 million, say you earn $6 million, what you do is you take the difference between 3 and 6, 1.5, you add that to the 3, and your cap is $4.5 million. You agreed to make all reasonable efforts to retain employees while you have the loan. But unlike PPP, the primary objective of this program is to save companies, not to save jobs. How will the bank calculate your EBITDA and any adjustments to your EBITDA? If you're working with a bank that you've previously worked with, that bank is going to do it in the same way as they historically have worked with you. If it is a new lender, they will have to choose a baseline of another company similar to yours that they have underwritten previously and use that baseline. Your debt will be calculated based on the date of your application to include all debt and unutilized lines of credit from both banks and private borrowers. If you have an asset-based line secured by accounts receivable inventory, what will account in your calculation is the amount you've borrowed based on your available collateral, not the amount that you could borrow on your line. So how do you pick between the new, the priority, and the expanded? Well, let's take as an example in row number 2, a company with $4 million of EBITDA and $10 million worth of existing debt. They could potentially get a new facility of 6, a priority facility of 14, or an expanded facility of 14. And what they would have to do is work it through with their banks, determine how much money they needed, see what rights banks were willing to give, if their banks were participating, etc., and figure out the best strategy for them. So how do you think about all this? Financing strategy is both offense and defense. I want to share with you 3 examples about how businesses we're working with are planning on using the facility. One is a company with a $3 million line of credit and 1 million drawn. This business is hoping that the line of credit has a personal guarantee and they're planning on getting an MSLP for liquidity. They would rather not PG the capital required to reestablish the business. I want to be clear that in 95 to 98% of the cases we're working on right now, the lenders are still demanding personal guarantees, even though it's not technically a requirement of the program. We're pushing them hard about this and had limited success so far. Example number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And the final example is a company that is already being approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. So how much cash will be required to get your business back on a stable footing? Have you modeled it out? What is the best case and the worst case scenario? And as you look into your business in the future, what does that look like? And what opportunities will you get? As the moderator starts to take questions, and I'm happy to take whatever questions you want, I need to quickly plug in my computer so I don't die on you. So I'll be right back in 30 seconds.
Thank you, Ami.
Go ahead, Hannah, you can start.
Are MSLP banks still requiring personal guarantees?
I just mentioned that it's on a case-by-case basis.
Ami, you need to come closer to the computer.
Right with you. I apologize. My mistake. Okay, now I can take all your questions and not worry about dying on you. So.
Yeah, PG.
Yeah, so the question is, are all MSLP lenders requiring personal guarantees? And the answer is that in 98% of the time, they still are pushing for it. We're pushing them back hard, and we hope we'll be able to break a few of them, but we just don't know yet.
On the buying of other businesses, what are your thoughts?
At this point, that is a completely permissible use of funds.
On new employees, what can you pay them?
It's a good question, Mike. We're not 100% sure how that will be calculated.
Since the SBA guarantees 90% of the MSLP, why are the lenders asking for a PG? If so, can't they go with 5% of loan guarantee?
Yeah, so first it's important to know this is not the SBA in these programs, but the Federal Reserve is guaranteeing 95% of it. And we are working hard to, the structure of the loan doesn't allow for it to be bifurcated, so they can't just cut off the one piece and not guarantee the other piece. But we are working hard to see if some lenders will come up with some other structures to allow for it.
We have a PPP question.
Okay.
What do you know about the new prioritized PPP?
I'm not sure what you mean by that question. The PPP program just got extended, but it's under the same rules and regulations of the old one. So I'm not sure what you mean by prioritized.
What are rules for 100% sub of a foreign company?
Can certainly apply as long as you agree in a test that you will not send the money overseas back up to your parent. Happy to take any other questions, folks. Questions are going once. Questions are going twice. Somebody's got to have at least one more question for me before the long weekend. Questions are going 3 times. So good, nice question. Says, how am I? I'm doing fine. Thank you very much. How do I plan on spending my weekend? Actually going to try to relax. I don't know if I'm going to succeed, but that's my goal. Is there a question in the chat, Hannah?
I don't believe so. Citywide. I don't know what the question is. If there's a question in the chat, can you repost? Will closing a second business exclude forgiveness if merged?
I'm not sure what you're applying to in this question, because I'm assuming that's a PPP program question, and I'm not sure. I'm sorry.
Do you have any formats for projecting cash flow, et cetera, in preparation for an application?
We do have some formats, and if you email us directly, we can happy to provide it for you. And we are working on 3 years of projections as of right now.
Fred, yes, we will be sending out this presentation later on this afternoon, the slides as well as the recording. Tommy, what are your fees?
Pat, we're happy to discuss those with you offline on a one-by-one basis.
How close are the lenders to opening up the program formally?
So Dave, lenders are open up, but not ones that are bending on personal guarantees yet. That's the challenge. That's what we're working on. Any other questions, thoughts, folks? Why are lenders not enthusiastic? Lenders don't stand to make a ton of money on these programs, and they're fairly complicated to execute. So they have to put it into their plan and have another reason for it. So in almost all cases we're working with, the lenders will take on the new loan if they can get a new banking relationship, as an example, or they can add another dimension to it besides purely just the loans. And there's a question, is there enough money now in MSLP? As of right now, there's plenty of money in MSLP. We have a question, should we hurry up to apply? Pat, the application takes some time. You have to find the right bank, get your application together, get through underwriting. And as of right now, the deadline is September 30th. So I think if you're interested in the program, it's smart to get going. Any other questions or thoughts? Okay, ladies and gentlemen, we sincerely appreciate your time. I wish everybody a long and fruitful and relaxing weekend. I hope my buddy Scott Reeves out there is going to go to his house on the, come on Scott, wave to everyone, say hello, I'm trying to embarrass you. He's going to go out to his house in Lake Tahoe and relax. And hope everyone tries to get some rest this weekend, and we'll catch up with all of you next week. Take care now. Thank you so much. Bye-bye.
Thank you.